Hey guys, Jamie Troll here. I am a CPA, financial literacy coach, and profit strategist. I've been watching all things stimulus as it has been changing continuously over the last several months, trying to help you as a small business owner or self-employed person navigate through this challenging time. So make sure that you subscribe to my channel because I have plenty of other videos that you will find helpful. I'm updating them very often, so make sure that you check and see my recent videos. We talk about PPP, we talk about EIDL, we talk about unemployment, all the things that you guys are wondering about. I have a video on it. So today though, what we're gonna really be talking about is the PPP forgiveness application. So specifically this video is to go through the long form application, but there's also an EZ application. So if you're not sure which one you need to do, watch the beginning of this video and you should be able to figure out which one you need to do. If you decide, you know what, I only need the EZ version, you can jump over to my other video, which is only about the EZ version. So check that link, it is down below if you know that you only have to do the EZ. But if you're not sure, or you know you have to do the full forgiveness application, then stick with me here. Okay, guys? I'm gonna walk you through the whole entire process. Now, importantly, I have a free tracker. If you do not have it already, you need to go get it because we're gonna be walking through it for the rest of this video. So you're gonna find it at balancecfo.com/PPP tracker. Okay, so you wanna go download that. I'm going to walk you through that. This tool is something that we've spent a lot of time developing this tool. We have updated it through all the changes. This is the application that came out on the 17th of June. So there's been a couple of different iterations. This is the most recent as of the recording of this video on June 26th. And so we have created this tool that will really help you. It'll fill out the entire application for you. Okay, the application is not the easiest thing to read, but we want to make something that can really help you fill this out. So I'm going to go jump right into the application and into the tool and start giving you that tutorial. So make sure that you sign up and you get one yourself. It'll be emailed right to you. So you have an option here. If you got your loan before June 5th, you can opt either the 8-week, which was the original time period, or the 24-week period. So you can decide what makes the most sense for you. In a lot of cases, the 24 weeks is going to make more sense, especially if you didn't already spend all of your money within the 8 weeks. If you already spent all your money within that 8 weeks, you can go ahead and just select the 8-week covered period. If you got your loan though after June 5th, then you have to use the 24-week period. So you can pick whichever one you're going to use, or you can take a look at both of them and compare them if you want to and see if they're any different. But I'm going to do this tutorial on the 24-week one. Overall, the process is the same though. So the calculations behind it are slightly different, but the process is the same regardless of whether it's 8-week or 24 weeks. So I'm just going to run through the 24-week one. Now, when you jump into this, you are going to go to the Start Here tab. And the Start Here tab is obvious, right? We want to start here. So it's really where you're going to determine which application do you need to use to apply for forgiveness, okay? So in this one, you're going to answer 4 different questions, and these 4 questions are really the basis for whether you can apply using the EZ form. We all want to try to target being able to use the EZ form to apply, okay? So when you jump into here, you're going to see that there's 4 questions. If you are self-employed and you don't have employees and haven't, then you will be able to check this first box, yes. So you'll see it's the borrower, self-employed, independent contractor, sole proprietor who had no employees when you applied for PPP, and you did not include any employee salaries in the computation of average monthly payroll. So if you applied and didn't include anybody but your own salary in your PPP application, you can say yes here. Then you actually do not need to do any of the other answers because that's the only one that matters in this case. Now you'll see down here that you have met EZ Form Criteria 1, and that now says use Form 350 EZ to apply for forgiveness, okay? But let's say that wasn't true and we kept going in this case. So let's say that wasn't true. And we're going to drop down to the second criteria. So the second criteria is the borrower did not reduce annual salary or hourly wages of any employee by more than 25% during the covered period or alternative covered period compared to the periods between January 1st and March 31st. And it talks about that. So basically, if you did not reduce your employee's salary, and this is base salary we're talking about, so that doesn't include commissions and tips and all of those things. This is base salary or hourly wage. So previously, if you were paying them $12 an hour, if the same employees came back and you continued to pay them $12 an hour, then you could say yes here. So as long as you did not reduce any employee by more than 25%, now that's employees, if you have the same employees, if they're different employees, then it doesn't matter. But if they're the same employees, you cannot reduce it by more than 25% and be able to qualify for this EZ form. So let's say in this case that we say, yeah, actually that does apply to us. That's true. You'll notice that still though, we have some more criteria we have to meet. So we have to meet also this one and one of these two in order to meet the criteria. So let's keep reading. So the borrower did not reduce the number of employees or the average paid hours of employees between January 1st, 2020 and the end of the covered period. Remember, that's the end of your 8 weeks or the end of your 24 weeks. Ignore reductions that arose from an inability to rehire individuals who were employees on February 15th if the borrower was unable to hire similarly qualified employees for unfilled positions on or before December 31st. Okay? Also ignore reductions in an employee's hours that the borrower offered to restore and the employee refused. So there's a lot of caveats in here. This one is a little clunkily worded. I'm not really a huge fan of how they worded this out because I had to read it probably 100 times before I really understood what they were getting at. Because I think you read it on its face and it says the borrower didn't reduce the number of employees or average paid hours between January 1st and the end of the covered period. Well, you probably did at some point, right? You probably had to shut down or maybe lay off employees or something like that to where you did actually reduce the number of employees or the average paid hours of your employees between that time period. And so you would maybe think that the answer there is no. But I think what this is really getting at, especially when you consider the fact that it talks about ignoring reductions that arose when you tried to rehire, I think this is really talking about from a point in time, right? So meaning from the time that you, from January 1st, to the time that you are applying for forgiveness, the end of your covered period, which is generally you want to probably apply pretty quickly after the end of your covered period. Now you can apply before the end of your covered period if you've used up all of your money. So you can apply if you pick 24 weeks, you can apply after 16 weeks if you've used up all of that money. So that would kind of be considered the end of your covered period in that regard. But basically, if you have the same number of employees, full-time equivalent employees, remember, so that is considering part-time employees are basically considered as a portion of an employee, right? But if you add up your full-time equivalent employees between January 1st, and you look at the January 1st number, and then you look at the end of your covered period, or when you're applying for forgiveness, what your number of employees was, if it's the same or more, then you're good, right? And there are some exceptions that even if it is less, that if it's less because you tried to restore employment and your employees refused, perhaps they wanted to stay on unemployment or something like that, which you are supposed to then actually, if they refuse employment and you know that they're taking unemployment, you are supposed to report them. Document the fact that you could not find other people, that you looked and there were no other people that you could find that would be similarly qualified. If you can document that, then that won't hurt you and you can still claim yes to this. But let's say, you know what, actually we laid off a bunch of people and we didn't bring them back because we just didn't have the work for them to do. Then maybe we would say no, okay? So now notice we're still not meeting the EZ forgiveness. Now, if we come down to the borrower was unable to operate during the covered period at the same level of business activity as before February 15th due to compliance with requirements established or guidance issued between March 1st and December 31st, the Secretary of Health and Human Services, the Director, Centers of Disease Control and Occupational Safety and Health, related to the maintenance of standards of social distancing or any other work or customer safety requirement related to COVID-19. Okay, what does all that mean? what that is really saying is if you couldn't operate at your same level between when you got the money, so when you got your PPP and when your covered period ends, if you couldn't operate at the same level during that full time because of what's going on with COVID, and that doesn't mean because demand went down, but perhaps you had to shut your building down because you actually were under a government mandated shutdown. Or maybe you could maintain services, but you had to be socially distanced, and that allowed you to not be able to take as many customers as you normally would, right? So if you're a restaurant and you couldn't allow as many people in, or you had to shut down the inside and only do delivery, right? So regardless of whether you shut down completely or not, then you likely can actually can check this. So the only instances really that I can think of where you couldn't check this is if you were able to continue with your business, or maybe your business was down, but you could still do all of your business remotely, or you didn't have to fully shut down anything at all, then you wouldn't be able to check this box. But in a lot of instances, you're going to be able to check this box if you shut down at all during the time that you had PPP money. Now, if you didn't get PPP until after the shutdown was over, you couldn't necessarily count that. But if you got PPP money and you had to stay socially distanced and couldn't take as many customers because of that, then you likely could say yes to this. So I think that this will be pretty broad in who can actually say yes to this requirement. And even if you say no to all of these other things, except for this one, you still have to maintain hourly and salary wages. But if you said yes to this one, you're going to meet your forgiveness criteria 3, and then it's going to tell you that you get to use the EZ application form. Everybody should be striving to use the EZ application form. Okay, if you at all can, you want to meet one of these criteria. All right, so just make sure that you're being cognizant of that, because if you can't meet this last one for some reason, then you need to make sure that your FTE count at the end of your covered period is the same as it was as of January 1st. Okay, so you can really work with that to make sure that you can meet those requirements. And the thing is, if you don't meet those requirements, what does that mean? That means you have to do the full forgiveness form, and the full forgiveness form requires quite a bit more calculation around your average FTE count versus a prior period, and around that salary hourly wage reduction on an employee by employee basis. It takes a lot more time to do the full forgiveness application. So you really, really, really want to be targeting to fill out the short form, the EZ application. And you really have a lot of control over that. So just pay attention to these specific things, and that will help you a lot. Okay, so let's say you've gone through that process and you realized, oh no, I cannot qualify for the EZ application. And you're gonna have to do the whole long form application. Okay, if that's the case, then you're gonna want to watch the rest of this video where I'm gonna tutorial the full long form application. If you realize by going through the start here that you can do the EZ, then I want you to go click the link below that's linked in the comments below to the video that's just for the EZ application, because we'll cut out a decent amount of this work that you don't really need to know about because you get to do the EZ application. But if that's not you, if you're doing the full forgiveness application, let's walk through it. So what you're going to do in that case, you're going to go straight to the tab that says Loan Forgiveness Application. Now, you can ignore, yours will not have any numbers in it. I've got some numbers filled in here for example purposes. So yours will be blank. But you're going to see up on top that you're going to have instructions to complete this. And it's going to tell you which tabs you need to do. So basically though, if you're doing the full application, that means you have to fill out all the tabs. So there's step 1, 2, 3, and 4 within this workbook. You're going to do all of them. Okay, they're the yellow tabs for the most part. And you're going to see the color key as well, which is going to tell you that only things that are in yellow are things that need to be completed by you. Everything else is auto-calculated. So all the blue, you don't need to touch. In fact, you're not going to be able to touch it because it's going to tell you that it's linked from somewhere else and you can't make a change. So ultimately, you're going to take a look at this, but this is basically just going to tell you, you know what? You have to fill in all of these. And once you fill in all of these steps, this entire forgiveness application will be completed for you, okay? This is gonna the whole thing is going to be filled out when you're done, and then you can come back to this tab and review it for accuracy. So same thing with this loan forgiveness application Schedule A. That is also a required schedule if you are using the long form. You have to actually turn this form in as well. And this is all going to be auto-calculated as well off of the other worksheets that you complete within this tracker. So let's jump on over to step 1, which is the loan tracker. So what you'll see here are a variety of questions that are used to calculate out the amounts for your forgiveness application. Now, looking through this, you can kind of see that we're going to start with the amount of the loan received. Obviously, we need to know that, the date you received it, and it's going to automatically calculate out your 24-week period, okay? Now, again, you don't have to use that entire 24-week period to pay PPP over, right? It's only 2.5 months worth of payroll anyway. So the expectation is you probably will run out before that 24 weeks is up, but it's automatically gonna calculate that maximum end date for you. Additionally, if you have employees, now if you don't have employees, this doesn't matter, but if you do have employees, there is an option to use an alternative covered period for payroll. What is the alternative covered period for payroll? Well, basically that is saying that you, instead of starting the clock basically when you get the money, which is the default, right? That you get the cash and that's the day that your 24 weeks or your 8 weeks starts, depending on which you choose, that instead you can try to align this better with your payroll periods. And this just helps administratively to do it this way, where it's not as difficult to kind of split out the amounts that you're going to have to put into the tracker. So if you have employees, you can choose the alternative covered period for payroll. Importantly, alternative covered period does not mean the 8 or 24 weeks. There's a little bit of confusion over that. That's not what the alternative covered period is. The alternative covered period for payroll is specifically saying you can actually start the clock for your loan instead of on the day you got it. You can start it on the first day after you received it that your next payroll period starts. So here's an example. Let's say you got it on the 25th of May, right? That's when your money was deposited into your account. Now, instead of starting the clock, you can start the clock on the 25th of May, but maybe your payroll period actually runs bi-weekly and you run your payroll every other week. You can start it on the day of your next payroll period. So let's say your payroll period runs from 6/1 to 6/14, right? Then you could actually start the clock on 6/1 instead. So that's an option. It's only payroll that applies to. It wouldn't apply to your other non-payroll, but it does apply to payroll. And importantly, remember again that it's incurred or paid, okay? So the cost just needs to be either incurred or paid during the time period. So let's say in this instance, you decide to use the alternative covered period, you start the clock on 6/1, and then on 6/2, your payroll period from, May 16th through the end of May is paid out, right? Because a lot of times it's paid out in arrears. That will count. Even though it was for a prior period that doesn't fall within that 8 or 24 weeks, it will still count because it was paid during that 8 or 24 weeks. That's important. It kind of allows you to get another payroll period in. Less important if you're using 24 weeks, because with 24 weeks, you have a little bit more flex, but this was really key, especially if you're picking 8 weeks, you sort of actually can get really an additional payroll period in there. That alternative covered period, though, only available if you are doing bi-weekly or more frequent payroll. So if you only pay monthly or you pay twice a month, you can't choose the alternative covered period for payroll. Okay, so continuing on down, it's going to also ask you, was your EIDL advance already subtracted from your PPP loan amount received? That might sound confusing, but what that really is to say, if you got an EIDL advance grant, not the loan, this is the actual advance or grant, the $1,000 per employee. If you received that money, it is going to need to be subtracted off of your PPP somehow. So in some cases, if you got that advance before you got PPP, it would have already been subtracted off of the amount of loan you would get, okay? So in that case, you would say, yes, it was already subtracted from it because we want to make sure we don't double count. But for most people, it was not subtracted. So you had the grant and then you got the PPP loan or vice versa. and you hadn't had it subtracted off of your PPP loan amount that you got. In that case, you would say yes here, okay? And then you need to put in your EIDL advance amount that you got. So 1,000, 2,000, 5,000, whatever it was that you got, put that here. That will be subtracted off of your PPP forgiveness. That is clearly in the CARES Act and now in Treasury guidance. It will be subtracted if it wasn't already subtracted when you got the loan. Okay. So did you have W-2 employees other than owners during the period? So this is for those of you, again, who are just owners and you don't have any employees. Obviously you'd say no. Or even if you're an S-Corp owner without employees, even though you technically are an employee, because this says other than owners, you would say no. If you did have employees, you would say yes, okay? All right, so I'm actually gonna fill out some of these so that we have kind of an example that we can go with. So let's say we got 100, you know what, I'm gonna do less, 50,000. Well, that's 500,000, 50,000. And we received cash on, let's say 5/25/20. So our end date for the 24 weeks would be 11/8, or if we wanted to start it on our next payroll period, let's say that started 6/1, that would be 11/15. So it kind of changes it by about a week. We would say the EIDL advance was not, we only got 3,000 because we didn't have a ton of employees. Yes, we have W-2 employees. And this will just say whether I want to use the covered period or this alternative covered period. I'm going to say alternative covered period because I like to align it better with my payroll cycles. That'll be a little bit easier. So we're going to do that. Okay, so now we're going to come down to the owner pay section. So this is where you're going to choose what type of owner you are. So you're either an S or C Corp and you are putting in W-2 wages paid. Remember, only W-2 wages are going to be eligible for forgiveness. So you have to pay W-2 wages if you're an S Corp or a C Corp. Okay, so you're going to list out your names and your W-2 wages. Importantly, you are limited to 2.5 months worth of W-2 compensation based on 2019, maxing out at $20,833. That $20,833 is basically $100,000 annualized to 2.5 months, right? Because the $100,000 is the max. So in this case, you're going to take your W-2 salary that you paid yourself last year in 2019, divide that by 12, multiply by 2.5. That's the max W-2 wages you can be forgiven for. Now you can pay yourself more than that, but you can only be forgiven for that 2.5 months as an owner. Okay, there are different rules. The maximum for employees is different. You can actually increase pay for employees, but not for owners because they don't want you to have a windfall because of PPP. Okay, so also, same thing here for partnership or multi-member LLC. You're going to have the same limit of 2.5 months worth. Note, we tell you essentially how to calculate that based on your K1. Or maybe you're a sole proprietor, LLC. This would be true if you're an independent contractor or something like that, self-employed. You would fall into this sole proprietor LLC. In this case, what you are essentially calculating your amount paid off of is going to be your Schedule C net profit line 31. That's what you're going to put in here, okay? So in this case, you're going to put in, let's say you maxed out at 100,000. That's the maximum you could get per owner. So maybe you made more than that. Then that would be the 2833 would be your 2.5 months worth of owner pay, okay? So that's your maximum that you would be able to take and be forgiven for. Okay, so then we're going to come down to this section here, which says if filling out EZ form to put in gross payroll. But if you're listening to this video, it's because you're doing the long form, so this doesn't apply to you. Again, if you're doing EZ, then go watch the other video that's just for EZ. But in this case, you unfortunately can't use this shortcut. You're going to have to do step 3 and step 4. Then down here, you're going to go down to your spending log. And your spending log is basically going to be just that. This is going to be for other things. So what goes on your spending log? Well, this is going to be your employer paid payroll benefits. So employer paid benefits, employer funded retirement, state and local employer taxes. Okay. So this is only if you have employees, or even if you yourself are an employee of your company. If you're a corporation, you're an employee of your company, then you would use this, right? But if you're a sole proprietor LLC, unfortunately, you can't have any employer funded retirement, things like that, because those are not Schedule C deductions. So you're going to put that all down here, and then you're also going to put other non-payroll, rent, utilities, mortgage interest, interest on debt obligations. Okay, you're going to put all of that down here, and you're going to kind of select it. I'm not going to fill out all of this. I'll do a little bit of so during the covered period, let's say 6, 10, 20, and 6, 20, and 7, 10, 20. Let's say the only thing I really have was rent to my landlord of $3,000 a month each of those months. Okay, and then I'm going to pick rent for both of these. Support kept. Hopefully it's not no. Hopefully the answer is always yes. You want to be keeping support for all of this because it could be asked for at any point in time. And let's say that came out of my Bank of America last 4 digits account. Okay. So that's what you're going to fill in. It's automatically going to pull this rent up into this summary here. And again, you would any of these types of costs you would put down here and categorize them. Okay, so now it's time to fill out the rest of the tracker. So we are going to go to tab 2 first, and we are going to fill out the FTE reference period. Okay, so what is the FTE reference period? One of the rules that if you do not meet Safe Harbor, okay, that you will have to do is compare your full-time equivalent employees from one period of time to another. So one period of time being a pre-COVID period of time, one period of time being a post-COVID. Basically, the second period of time is going to be your covered period, right? The period of your PPP money. So what we're going to do first is figure out the reference period. What were our full-time equivalent employees over the reference period? And there's a calculation that goes into that. So remember, full-time equivalent employees, it doesn't mean how many employees did you have. It is a calculation where each employee, if they're part-time, can be worth a partial employee, basically. So any full-time employee, meaning they work 40 hours or more, that counts as 1. Anybody that less than that counts as a portion of a person. So there are 2 different ways that they allow you to calculate for part-time people. That's using kind of the actual FTE, meaning you would take, let's say they work 10 hours a week, divide that by 40, and so that person would be like 0.25 of an FTE. That would be the actual FTE for them. Or you can kind of shortcut it and take the FTE alternate, which you can see we calculate both here, which is just to assume 0.5 for every part-time employee for every week that they are on payroll, okay? So let's do a quick example of this. So select the FTE reference period. This is the period we're going to compare against. So you have a bit of a choice in what period you're going to use as your comparison period. So you can do February 15th to June 30th, 2019. You can do January 1st, 2020 to February 29th, 2020. Or you can do seasonal to select 12 weeks between May and September. But you do have to be a seasonal business to be able to do that. It has to just be a consecutive 12-week period sometime in there. So let's go June 1st. January 1st to February 29th, 2020. So here's what's going to happen is it's going to populate automatically for you the number of weeks in the reference period. So it's about 8.5 weeks. It gets a little confusing because it's not an exact amount of weeks, that specific period. So we put 8.5 to kind of average it out. And now what we're going to do is determine, do we want to default to the FTE alternate method or not? And on all of these tabs, if you're confused, you can always watch back. But down here, we're always going to have instructions kind of in this green box down here. And so what this means is, do we want to just go with the easy method, being that we count a part-time employee as 0.5 for every week that they work? Or do we want to get more granular with it and calculate the whole amount? If you are worried about your FTE calculation, it can be beneficial to do the actual amount and the alternate and therefore compare them and pick the one that's most advantageous, but it does require more work. So if you're saying, you know what, I actually don't want to do the actual work, I'm just going to say, yes, we're going to default to the actual. Then when we come down to our hourly, so really quickly, salary is up here. This is important to know. So don't start putting hourly employees up here. Only salaried employees go between rows 11 and 110. Okay, those are only salaried. So if you don't have any salary, then you're going to skip all the way down here to hourly and start entering your hourly down below. So this is the case on a lot of these tabs. That's something to pay attention to because you want to make sure they're in the right place. But for hourly employees, okay, you're going to see now it's gray down here. Whereas because we basically aren't going to make you put in your hours every single pay period, right? If you're going to default to the alternate. So that's the benefit of just going straight with the alternate. You don't have to go pull the hours that they actually worked for all those pay periods. But let's say we wanted to kind of compare it out and see what's best. We could go down and put no, and now you can see all of these cells are yellow, meaning that's something that you would have to fill in. So what you're going to do is you're going to put in your employer name, whether they're part-time or full-time, and then the number of weeks they worked during the reference period. So if they worked the entire reference period, if they were on payroll that whole time, you would put 8.5. That's the important thing. If they worked for less than that, let's say you hired them halfway through and maybe they only worked the last 4 weeks, you would put 4. So let's say we had John and Susan and Sarah, okay? And John is full-time, Susan is full-time, and Sarah is part-time. And John was a new hire. He only worked 4 weeks. Susan, she was there for about 8.5 during the whole time period. And let's say Sarah, she was there the whole 8.5 as well. Okay, so you can see that they calculate out essentially based on that information that you put in, how many FTEs they are. And they might be the same or they might be different. So let's scroll on down. And then let's say we had a couple of hourly. So Max and Joe are both our hourly. We're going to say that they are both part-time hourly. And as far as the number of weeks they worked, Joe was pretty new, but Max was there the whole time. So you can see Max doesn't really come out to being that much of an FTE depending on how you calculate it. Now, you won't see anything in this column for actual because we haven't put any actual numbers in here, right? So we'd have to go through by pay period and you'd want to do 8.5, right? For Joe who was there for 8.5. And let's say he worked, it kind of varied a little bit. We're just going to kind of put some 1, 2, 3, 4, 5, 6, 7, 8, and then a half. And then let's say Joe was pretty new. He worked towards the end here, and he worked 15 and 30 hours. And then it's going to calculate out your FTE. So you can see in this instance that when you're using the alternate FTE method, it's coming out to a smaller number or a bigger number. It's coming out to 0.5 because it's assuming 0.5 for him. And this one, when you actually do the calculation, because he's working less than half time, it's actually coming out to less than 0.5. So again, it could go either way, depending on how many hours your employees work. And then down here, it's going to give you kind of a summary. And there are a lot of rows here, you guys. We added a ton of rows because so many of you asked for extra rows to put your people in because you had more employees than we had rows. So hopefully this should be enough. It gives you room for, I think, 150 or so employees. Okay, and then you're going to kind of get your FTE count. It's going to come out down here, and that's going to pull into the calculations you're doing automatically. So let's leave that as it is, and that's going to calculate out what our FTE count was for the reference period. Okay, then we're going to jump to step number 3. So step 3 is around payroll frequency. There are some questions. So step 3 really goes with all these orange tabs as well. So you fill out step 3 tab and then you pick the orange tab that actually corresponds with how often you run payroll, okay? So you want to put in right here, this is really important, you guys, don't miss this one, type of payroll. If it's not weekly, you're going to want to switch it to which one it is. So let's say in this case, we run payroll bi-weekly. And then you're going to answer these questions, which might be a little bit hard to see. So I'm going to scroll in a little bit. Okay, so you're going to answer these questions and you're going to say, did your number of FTEs increase? No, they didn't actually. They decreased. FTEs that met the reduction exception. So this is basically if you had made a written offer to them and they declined it, if you fired them for cause during the forgiveness period, or if they voluntarily resigned or asked and received reduced hours during the forgiveness period. You only need to put somebody here if it is someone that you did not then replace. If you replace that person, you don't really need to put anything there. But if you did not, you would want to put them in there. And technically, if they did ask you not to come back after you requested that they come back, you are supposed to report that to unemployment in your state, especially if you know that they are taking unemployment. And then you're going to come down here. And what this basically does, though, really quickly, is this just, it holds you harmless for those people. It will not impact your FTE count if you didn't get back to your FTE count because of these reasons. Okay. Now, let's say you were, here's another one. This is important. This goes back to the safe harbor. This is similar to what we asked on the very first tab, okay? But if you were unable to operate at the same level, because of social distancing, being closed, etc., you're going to input this. So likely, more than likely, if you did not meet the requirements for the EZ form, okay, you're probably not going to have FTE safe harbor. So what that means is you're going to have to look at the FTE change over that time frame. If you come out of this and you do get FTE safe harbor, you might want to look back and make sure you answered the questions on the EZ form correctly, because you might actually be able to use the EZ form. Okay, so this is going to come out and tell you the answer, and then this is going to ask you for your adjusted for the employees that met this reduction exception, right? Did you have greater than or equal to your February 15th FTE count on the date of the application, or December 31st, whichever is earlier? Again, this is fairly similar. There's some slight semantic differences and date differences here to be aware of, but ultimately it's really similar to the requirements to be able to do the EZ form. So most of the time, if you get safe harbor, you can do EZ. If you don't get safe harbor, you can't. Okay, so then when you've done this, you're going to come and remember there's a lot of directions down here if you're confused on what this all means. We've written it all out below. But once you've picked your type of payroll, you're going to go to that tab. And so in this case, we're going to go to the BiWeekly. And you can read up here what the instructions are. See, we just said sheet 3, right? Where we just were, has instructions for filling out this form. You're not going to include your owner pay on these forms, you guys, okay? That was counted separately, remember, in step 1. If we put it back here, we would basically end up double counting our owner pay. And then just like the FTE reference period, we're going to be able to enter salary employees here and hourly employees below, okay? So now we're going to do kind of a similar thing, but a little bit different back here. This is for the forgiveness period. So you should see the dates of the forgiveness period you chose coming through here. That's the period we're talking about. Now, in some cases, you may have used up all your payroll money before the end of the 24 weeks, if you chose 24 weeks specifically, right? If that's the case, then what you're going to do here is put the number of weeks that you spent it over. So if here you'd say, did you pay PPP payroll more than 8 weeks and less than 24? Yes. If yes, enter the weeks of payroll paid. Maybe you paid 12 weeks, okay? That just makes sure that these calculations are being done over the right number of weeks. Okay, so I jumped ahead and I went ahead and filled out some of this information for people, okay? So for John, Susan, and Sarah, I went through and put some base wages into the calculation starting with week 3 because we hired them back 3 weeks into getting the PPP. And for Sarah, let's say she's a commission-only employee. So that's important. She doesn't have a base salary at all. If she had base salary and commission, you'd put them separately. But let's say she was only commission. Well, in this case, you can just put it in the commission column. One kind of funny thing, if you have any employees like that, by the way, you will want to put in kind of a 0.001 or 0.0001 cents into one of these base wage calculations. Otherwise, what it's going to do is give you kind of an error. So if you want to just make sure that that calculation works, you may have to kind of put a small, tiny little number in there just to make the calculation pick it up. And then it's going to say, well, her average annual salary or hourly wage for the case of this calculation was $0. Okay, so remember, when you're having to keep up that base wages, right? Like when you're comparing your previous to your current and making sure that your salaries or wages have not dropped by more than 25%, you're only looking at base wages. So in this case, for commissioned employees, the good news is you really kind of can't fall under it because they don't have a base wage. So you really kind of can't reduce it by more than 25%. So anyway, it's going to calculate all of that out, and then it's going to average out their FTEs. It's going to average out their average annual salary or hourly wage, okay? And then what you're going to do is come down to hourly. And let's say we only hired back Max, only one of our 2 part-time employees. All right, so it's going to put him in here as well. And what we're going to do is we're going to put in his number of hours for each pay period and the base wages. So he pays, let's say, $15 an hour, and it's going to calculate out that pay, okay? So once we're done with all of this and we feel good about everything calculating, and you can come over here and just make sure that the total wages agrees to what you think and the number of pay periods, right? So once you feel good about this, you can jump over to the Schedule A worksheet. So this is the Schedule A worksheet. And you will notice that some of the information is automatically coming in here, right? So you've got John and Susan and Sarah, that cash compensation that they were paid came through, okay? And the average FTE came through, and it automatically picks the one that's more advantageous for you. And then their average annual salary, excluding variable pay, came through as well. Remember, this is talking about, since we only had commission, she's variable pay, so she's 0. So that's completely fine. And then down here, we should see Max. And here's Max. So you can check to make sure all your employees are flowing in here and all their information is coming in, okay? Okay, so once we're done with that, we need to make sure that we answer this question, which is select yes if either of these 2 statements apply. Either you're filling out the form EZ, okay, well, you're not, right? Or the salary hourly wage reduction, we didn't reduce wages by more than 25%. So if you don't know, you wouldn't answer that one. And you'll click here, and it's either going to be yes, no, or don't know. So either if you put yes, the big change will be all of this over here is grayed out. You do not have to do the salary hourly wage reduction calculation if all of this is grayed out, okay? If you click yes here. Now, if you do no or don't know, it's gonna make you fill out all the information, okay? Okay, so now let's look at how that salary hourly wage reduction calculation happens. And this is the calculation because you have reduced a particular employee's salary by more than 25% likely of their previous salary, right? So we're going to start this, and we're going to come over here and say, okay, first we're looking at John. And you can fill in this information. John is not a new employee. We had him during the FTE period, okay? Oh, not a new employee. See, notice that if he were a new employee during the forgiveness period, you wouldn't have to fill out any of this because you don't really have anything to compare back to because he's new. So even if you have a different person taking an old job, you still would say yes here. They were a new employee. There's no comparison to be done. But in this case, let's say you say no. Their annualized salary was not over $100K in 2019. You could put in their last 4 of their social, and then you're going to carry across, and it's going to have his cash compensation, his average FTE, etc. Okay, so now when you come over here, we've annualized out what the annual salary based on what we paid them during the forgiveness period would be. So maybe that's their normal salary. So let's say, actually, yep, we paid, the same thing we normally did, and that's 100%. Now you're done. And once you get this, you don't have to keep doing any of these over here. There is no salary hourly wage reduction if you get to this where it says done. Now, however, let's say for January through March, right, 2020, that's the time period we're looking at, his salary was $40,000. Uh-oh, Well, that's only 65% of what the salary was that we were paying him during the forgiveness period. Okay, so we actually did reduce his salary, cut his salary down. So if that's the case, then we're going to go to step 2, as it tells us. And now we got to look at February 15th. What was the average annual salary during the pay period where February 15th falls? So you'd go look back at that pay period and say, okay, well, it was still $40,000 then. We hadn't reduced his pay yet. Now, February 15th through April 26th, what was the average salary? So maybe it was still that $40,000. Maybe we didn't reduce it until he came back from us laying him off, and then he came back during the forgiveness period at a lower rate. So now it's going to tell us to go to 2C. So you just kind of follow what the directions are telling you. And now, forgiveness application date or December 31st. So whatever date is earlier, you're going to pick the date you're applying for forgiveness or December 31st. What was their average annual salary then? So you can see if we left it at the $26,000, right? We don't have safe harbor. We reduced it by more than 75 or than 25%. And so we have a reduction amount. And this reduction amount is being calculated and comes over here as a salary hourly wage reduction and can very likely then decrease the amount of forgiveness you could be eligible for, okay? So we paid him $5,000, but technically $1,800 of that is not going to be eligible for forgiveness because we didn't bring him back to his old salary. Now, if we said, you know what, by this date, we bring him back. So make sure, and this is where we have control over it, right, as an employer. By this date, if we go, okay, 40,000, whoops, not 4,000, 40,000, now you got safe harbor. But you'll see this, that even with safe harbor, even if you go a little bit less, you're not going to get it. So you want to get it back to what it was as of February 15th in order to get safe harbor. Okay, so I'm not going to go through this for all the other ones, but again, you won't have to do anything for Sarah because she's commission only. So really, it's still going to be 0 and you're going to be good to go. Okay, and then same thing, you're going to do the exact same thing for max down below for the entire application is to go back to the calculation form. So make sure everything looks okay, make sure everything's pulling in okay. Make sure that it looks reasonable to you. So it should show you your payroll costs and any other costs that you had. It will calculate your FTE reduction quotient. Remember, that's the fact that you reduced your FTEs. You're getting reduced a little bit for that, okay? We didn't have a salary hourly wage reduction, so that's showing 0. But if you did reduce those wages past 25%, and did not restore them, then you'll have a number there. And this is going to give you a modified total. So you'll notice that the FTE reduction can have a pretty profound impact because what it is really doing is it's calculating your line 6, so your total that you spent, times the FTE reduction quotient. So that can actually have a pretty big impact. In this case, we reduced FTEs quite a bit, so that's why you're seeing a big impact. But that will, you'll see now, reduce your total potential forgiveness amounts. So you spent $39,000, but you're only going to get forgiven for $16,000 in this case because you didn't bring back all your FTEs and you didn't get it back up by the end of the period. And your PPP loan was $50,000. This is just saying how much, if you had met basically like how much your total forgiveness could have been after you meet the 60% payroll requirement. But basically it's going to take the smallest of these. So in this case, it's going to be this one. In a lot of cases, it's going to be this one if you didn't get full forgiveness, okay? And it's going to kind of summarize down here. Okay, you're $16,000. Then you're going to have your EIDL advance subtracted, and you're going to have $13,000 forgiven. All right, so this is going to calculate out your forgiveness. Now, importantly, then you're going to want to go to your Schedule A. That actually feeds into it. So this is also going to show your average FTE and all of those calculations here. And you're going to want to review that too, because this also goes into the actual application. So the last thing that you're going to want to look at is this last Diagnostic tab at the back of the workbook. And this is just one more way to look at the total picture of your forgiveness. So it's going to tell you the total amount spent, how much of your loan remained unspent. Remember, if you don't spend it, it's not going to be forgiven. Then it's going to go into your FTE count and the comparison there between your comparison period and your covered period. Here you can see the big decline, right? So here you can see why we're having that big FTE reduction, because we actually brought back less than half of our staff when you calculate it all out. And then you're going to come down here to your forgiveness. So our total loan was $50,000, but remember we only got $16,000 calculated because of that FTE reduction quotient. Then we got to subtract our EIDL advance on top of that. So now we're only getting forgiven for the $13,000, which leaves $36,000, which will become a loan. So this just gives you another snapshot to take a look at to kind of sense check your forgiveness application. So there you have it. That was the full forgiveness application tutorial. I know that was a lot. So now you can see why, if you can at all manage it, doing the EZ form is going to be so much easier, right? But hopefully this will help make it a little bit easier to actually have a formula to go through and put all these amounts in and see where you come out. Okay? Now, if you have more resources that you're looking for, make sure to subscribe to my channel. Come on over to my Facebook group, Financial Literacy for Women Business Owners. Even if you're a man, we have several men in there. Facebook is where I'm answering all of your questions. So if you have questions on this or something's not working quite right, that's the best place to go to get those answers. So I'll see you guys next time.